Okay, I see one question on what's the stock code for this ETF. The SGX stock code for Sing dollar is YYY, RMB is YYR. What currencies can the ETF be traded in? After listing on 2nd August, it will be Sing dollars and renminbi. Okay, and next question on SRS and CPF. Okay, SRS is available as a subscription avenue only after listing on 2nd August. CPF will not be available as a subscription avenue in both IOP and also in secondary market. And distribution policy will be annual and at June every year. In terms of the management fee is 0.45% and total expense ratio is at 0.62%, capped at the first 2 years from the fund's inception. Okay, in terms of the dividends, the dividend rate will be announced in June. So after that, by the fund manager, which is us. So after that, the distribution will be made. Okay, for the question by Eric, is this the only ETF with this index? Okay, within Singapore right now, this is the only ETF with this index. And in fact, we customize this index, especially ask Hang Seng to make this index. But it's up to be able to create this ETF. Okay, there's one question on why some companies have A shares and A shares included in portfolio. For example, like Ping An. Okay, this is because these companies, they are listed in both mainland China and Hong Kong. And the weighting of these A shares and H shares depend on its free float adjusted market cap. The A shares and H shares separately and respectively. However, the aggregate and total weightage of these companies, which are dual listed, will still be capped at 8%. Okay, there's a question on house view regarding China's clampdown on Chinese tech stocks and outlook. Okay, so in terms of the house view, what we believe is a healthy dose of regulations will be important to protect consumer rights and prevent monopolistic behaviors. And this will ultimately, I would say, be a positive for the development of these industries. However, it's also unlikely for regulators to over-regulate and suppress innovations, which they are also actively promoting for the economy. So although we don't know, I would say, when the regulations will eventually relax or like when it will start relaxing, China's stock market until now has already priced in a lot of these risks. So any relaxation, I would say, will be a reprieve for the market. So there's a question on financials being the industry with the highest weightage and outlook for Chinese financial sector. So regarding this, the economic growth in China is strong and we expect robust loan demand, rising loan rates, and also less reduced bad debt. In fact, PBOC announced they would use the RRR ratio, which is the required reserve ratio, by 50 bips last week, and which suggests that Chinese government is becoming more dovish and is the policy support economic growth. And these release in liquidity from the cut in RRR will also help lower credit costs in Chinese banks. And valuations right now, I would say, are attractive, especially for Chinese banks, because the share prices previously already reflected the pessimism, including, for example, like declines in the net interest margins, which have been captured inside the current valuation. So because of that, we are positive on financial. Thank you for joining. Thank you so much for listening in today.